What if there was a secret ingredient that could ensure a startup's success?
You mean like a magic formula?
Not magic, but more of a blueprint. A business model to navigate the unpredictable world of startups.
Interesting, and what would this blueprint look like?
Well, it would have to include an examination of key parameters like profitability, scalability, and sustainability. These are the factors that can influence how a business operates, grows, and adapts to changing circumstances or markets.
But isn't every startup's blueprint unique?
Absolutely. And that uniqueness is derived from their competitive advantage or value proposition. While there may be common factors like those I mentioned, each startup's business model would ultimately be their own unique interpretation of these core principles.
Got it. So it's not a one-size-fits-all model, but a personalized map to success.
That's a good way of putting it. And as we journey through today's discussion, we will analyze multiple business models and understand what works and what could potentially fail. Let's unfold the mystery behind successful startup business models. What are the essential elements of a freemium business model?
Fundamentally, a freemium business model offers basic services for free, while charging for premium or additional features. This is a strategy designed to attract a large user base before monetizing through premium services.
And how does this apply to tech giants like Spotify and LinkedIn?
Think about how Spotify operates. You can listen to music for free, but to remove ads or to download music, you need a premium subscription. The same applies to LinkedIn, where enhanced features are available only with a premium subscription.
That makes sense. It seems like a potent strategy. Are there any downsides to this model?
Sure, it's not without its pitfalls. If a company fails to balance the free and premium offerings, they might see little to no conversion from free users to paid ones. Additionally, determining the perfect price point for premium features can be a complex task, as one must yield profit without scaring off customers.
So it's a balancing act then.
Indeed it is. However, skillfully executed, it can be highly profitable, which brings us to Netflix and their subscription model.
How is that different from the freemium model?
With a subscription model, there's no free tier. Your access to service is dependent solely on your subscription. Netflix offers access to all its content for a monthly fee, guaranteeing a steady revenue stream.
Surely, with how overwhelming Netflix's success has been, there can't be any disadvantages with this model, can there?
While Netflix has indeed been successful, subscription models also have their challenges, one being maintaining value for subscribers. If the content isn't perceived as worthwhile, users may unsubscribe. Remember, in the subscription model, customer retention is just as important as acquisition.
So, Natalie, we've explored freemium and subscription models. Moving on, what can you tell us about peer-to-peer business models, as seen with Uber or Airbnb?
Peer-to-peer business models, or P2P, refer to startups that provide a marketplace platform. These platforms permit the interaction and transaction between two users, the provider and the consumer. Take Uber, for example. It enables drivers, the providers, to offer rides to passengers, the consumers.
I see. The company acts as a facilitator for these transactions then?
Precisely. And it's not just about facilitating. These platforms also take care of things like payment processing, providing a framework for reviews or ratings, and handling any disputes or issues that arise. Airbnb follows a similar model, but in the domain of accommodation.
What sets these models apart from others?
What sets peer-to-peer models apart is they don't own the primary assets involved in their operations. Uber doesn't own cars, and Airbnb doesn't own properties. Their primary asset is their platform and the community using it.
Interesting. Now, what about franchising? How does that work as a business model?
A franchise model is suited for businesses that have a proven operational model and a well-recognized brand. The franchisor, like McDonald's or Subway, licenses its business model and brand to franchisees, who then operate their own locations of the business.
And the franchisees pay for this access, right?
Typically, yes. Franchisees pay an initial franchise fee and subsequent royalties based on their sales. They get access to the franchisor's business model, support, and brand recognition. It's essentially a trade-off between short-term startup costs and long-term business viability. Diving into the world of revenue streams, Charlotte, Wouldn't you say that variety truly is the spice of life, even for startups?
Well, Natalie, startups indeed need to diversify their revenue streams, similar to how investors diversify their portfolios. It reduces the risk of cash flow problems and balances the financial health of the company. But there should also be a limit, shouldn't there be?
Sure, Charlotte. Diversification doesn't mean venture into all swimming lanes. Instead, it emphasizes discovering multiple reliable sources that complement your business.
Could you give us examples?
Definitely. Let's take a platform like YouTube. Their primary revenue comes from advertising, but they also generate funds through YouTube Premium subscriptions, channel memberships, Super Chat, and YouTube TV. Each of these revenue streams appeals to different user needs and provides continuous cash inflow, proven to be quite successful for them.
I see, so these multiple revenue streams not only diversify income but also make them resilient against market change and evolving customer preferences. But aren't there startups that stick to a single revenue stream?
Absolutely. Single stream can work, particularly in early stages. Consider Calm, the meditation app. It started with a subscription model. However, once established, they also diversified with partnerships, merchandise, and corporate packages. So, even if initially they depended on a single revenue stream, they expanded as they grew.
Seems the key lesson here is understanding when and in what to diversify, isn't it? Pivoting, Natalie, is an act of shifting a startup's business model, often as a reaction to market feedback. Why do you think it's crucial for startups?
Well, Charlotte, startups, by definition, are operating in uncharted territories. They're attempting to carve out a spot in the market. And along the way, they might realize that the business model or revenue streams they initially thought were viable aren't precisely working out. That's when pivoting might become necessary to survive.
Absolutely. Any examples of successful pivots that come to mind?
Certainly a classic one is Twitter. It started as Odeo, a platform for discovering and subscribing to podcasts. But as iTunes progressed, Odeo fell behind. The team realized that they had to pivot to stay relevant, and Twitter was born.
That's quite a successful leap, from podcast discovery to a global social networking platform. But it isn't easy for every startup to pivot flawlessly, is it?
No, Charlotte, it certainly isn't. Deciding to pivot is a big step, and it comes with its own set of challenges, not least the financial implications and instability it can bring. But what I think is key here, and that's also what the crew at Odeo probably realized, is the importance of listening to market feedback and being open to change.
So it's about being adaptable, almost having a sort of flexibility ingrained in the company ethos from the start. That may be the factor that separates the successful pivots from the not-so-successful ones. Jumping back to our discussion on cost analysis, Natalie, from planning the development stages until getting that first seed capital, how would you go about analyzing costs?
Well, Charlotte, realistically speaking, the first step has to be a thorough understanding of your fixed and variable costs.
So what exactly is the difference between them?
Fixed costs, as the term suggests, remain constant, regardless of production volume. These include costs like rent, salaries, and the like. Variable costs, on the other hand, fluctuate according to volume. Think raw materials or sales commissions.
Isn't it quite challenging to accurately estimate these costs, particularly during the early stages of a startup?
Yes, it can be. Without a historical point of reference, projecting these costs involves a lot of guesswork and market research. It's also essential to remember that these projections will need to be adjusted as the startup grows.
So, cost projection is a continuous process. What happens, though, if a startup underestimates these costs?
Underestimation carries serious repercussions. It may mean running out of funds faster than anticipated, which could cripple operations. It also means you may have to prematurely seek more funding, which could devalue your equity much earlier than planned.
Given the potential pitfalls of underestimating costs, Natalie, do you believe finding a balance between fixed and variable expenses is crucial for startups?
It's not just crucial, Charlotte. It's vital. A startup that cannot balance its fixed and variable costs will find itself treading dangerous waters financially. Let's consider an example. Suppose a startup invests heavily in fixed costs, buying fancy office space and high-end equipment. But what if their sales don't pick up as expected? They're left with high outgoing expenses without the variable income to cover them.
Sounds risky indeed. Any practical examples to illustrate this point?
For sure. Consider the food delivery startup Sprig. Known for preparing gourmet meals and delivering them to customers, Sprig invested heavily in fixed costs, from well-equipped kitchens to skilled chefs. When sales didn't meet expectations, the company was eventually forced to shut down.
That's a sobering reminder that cost balance is critical. But on the other hand, a skewed focus on variable costs might limit growth potential too, right?
Well spotted, Charlotte. This is precisely why startups must balance costs. An overemphasis on variable costs compromises quality and delivery, which can inhibit customer satisfaction and growth. A classic example would be a business that decides to outsource key functions to save money, overlooking the lack of control and potential communication barriers this could introduce.
It sounds like a real tightrope walk managing costs as a startup. Running lean but also ensuring scalability and quality. It's quite the challenge.
But it's this constant recalibration that makes startups so flexible and exciting. Not an easy task, but definitely worth it, when you see the startup growing exponentially while managing its resources effectively.
Taking a look at profitability. Natalie, how do you imagine startup might forecast their profitability accurately?
Well, Charlotte, it starts with a sound financial model, built upon realistic revenue projections and cost estimations. You need thorough research on market size, competition, pricing strategies, operational costs, and of course, the investment required. But it's not just about numbers, it involves questioning every assumption in your model and stress testing them.
Stress testing, can you elaborate on that?
Sure, it means the assumptions in the financial model should be tested under various scenarios. For instance, what happens if the customer acquisition cost is twice as high, or the growth rate is half of what's projected? A thorough stress test often unravels many weak spots in profitability forecasts, helping startups avoid major pitfalls.
I see. A comprehensive approach indeed. Now, on to common mistakes. From your experience, what do you see entrepreneurs often get wrong?
Many times, Charlotte, founders overestimate their market size and underestimate their costs. They fail to see that not everyone in their market will become their customers, and they often overlook hidden costs or contingencies, which can seriously harm their profitability in reality. Over-optimism is not a bad thing for entrepreneurs, but it can distort their financial projections.
A sobering thought, being optimistic yet realistic. It's essentially grounding dreams in financial reality. Can you relate this insight to your food truck dream, Natalie?
You're right, Charlotte. In my food truck dream, I was excited about bringing my grandmother's recipes to New York streets. But I knew that I had to consider various costs, from ingredients to vehicle maintenance, licenses, and even the unpredictable weather. My passion is fueled by my realistic approach to profitability.
Scaling, Natalie. How does an idea grow into a multi-billion-dollar venture?
Interesting question, Charlotte. Scalability is the ability of a startup to grow in size or revenue, while maintaining or even improving its performance. An excellent example would be how delivery startups efficiently manage their fleet to meet increased orders.
How can a startup ensure it is built for scalability from the very beginning?
Well, it starts at the drawing board. The business model must accommodate growth, meaning it can replicate its operations while adding new customers and tapping into new markets. For instance, subscription-based services like Spotify can simply add more servers as their user base grows. But a personalized cooking service, on the other hand, would struggle, as it can't clone the chef.
I get your point, so a scalable business model works with more volume. But are there any downsides to scaling quickly?
Yes, rapid scaling comes with growing pains. It might strain your resources or put pressure on the team, sometimes leading to a drop in quality. There's a fine balance startups must achieve to scale effectively.
So, Natalie, let's talk sustainable business models. Any thoughts on this?
Well, Charlotte, it's a three-pronged approach, really, all about balancing profits, people, and the planet.
That's the triple bottom line. Can you give me an example?
Sure. Let's consider a startup that makes eco-friendly soap. The business must stay profitable while ensuring fair wages to its workers and making sure its product doesn't harm the environment.
And that's what makes it sustainable?
Exactly. This kind of business model is beneficial in the long run as it takes care of all aspects: financial, social, and environmental.
Sounds ideal but hard to attain. Any successful examples?
Let's take Patagonia. They create durable, high-quality outdoor wear while promoting sustainable practices and overseeing workers' conditions and wages. True to the triple bottom line.
Interesting. Having such sustainable practices could give startups an edge, don't you think?
Absolutely. In this age of social consciousness, consumers are increasingly drawn towards businesses that are environmentally and socially responsible. So, sustainability can indeed be a competitive advantage.
Now that we've discussed the importance of sustainable practices in businesses, do they also have an impact on a startup's competitive advantage?
Of course, Charlotte. The way I see it, sustainable practices help startups differentiate themselves in today's market, where consumers are becoming more environmentally and socially conscious.
Similarly, in an investment landscape, do angel investors and venture capitalists value startups that show a commitment toward sustainability?
Definitely. In my experience, those startups that embed sustainability into their core are often viewed more favorably. They can showcase resiliency towards potential changes in government regulations or consumer behavior associated with sustainability.
So if sustainable practices can drive a startup's competitive advantage, then can it also influence their overall value proposition?
Yes, absolutely. In essence, the value proposition is the promise of value a company promises to deliver to its customers. If a startup leverages sustainability as part of its core operations, it can be a unique selling point. This, in turn, can increase the startup's value in the market.
That's a key takeaway, Natalie. If sustainability is so central, what are some strategies startups can use to incorporate this into their business model?
There's so many ways. Startups could promote involvement in community engagements, practicing transparency in their operations, striving for business process optimization to reduce wastage, and of course, ensuring a fair and safe workplace environment. Each of these practices, when done rightly, can significantly boost a startup's value proposition while making it more appealing to both consumers and investors.
Moving to real-world examples, let's consider Uber. How does its business model operate, Natalie?
Sure, Charlotte. So Uber has an aggregator business model. They don't own any vehicles but connect drivers with riders through their platform. Uber earns revenue by charging a percentage fee on each ride.
Right. And it's interesting to note that Uber has scaled globally in a short period. It's a good example of how impactful scalability is.
Exactly. Scalability played a major role in Uber's success. Speaking of scalability, let's touch upon Netflix. They offer a subscription-based model, further fortified by their original content. Their model has demonstrated scalability with millions of subscribers worldwide.
And that original content acts a strong competitive advantage too, doesn't it?
Definitely. In a competitive streaming market, their exclusive content sets them apart. On that note, another excellent example is Spotify. They've utilized both freemium and subscription models to reach a broad array of audiences.
Interesting. So they've effectively balanced the need for user acquisition and revenue generation?
Precisely, Charlotte. Through their freemium model, they provide free, ad-supported access to attract users. Concurrently, the paid subscription offers an ad-free experience with additional features, contributing a major part of their revenue.
So, Natalie, we've observed that business models evolve continually, aligning with technological advancements or markets trends. Today, one notable trend is the emergence of platform business models. How does that differ from the conventional models?
Platforms are essentially spaces where producers and consumers connect, like Uber or Airbnb. At the core, these businesses don't produce anything. They essentially facilitate interactions and transactions between users. Their value comes from building, maintaining, and expanding a network of users.
Some might argue this isn't that new, but it's certainly seen a deeper penetration in recent years. Another game-changing trend, especially for businesses with significant data, is the use of artificial intelligence. Is that strategy working well for startups considering it requires hefty upfront investment?
It certainly has its drawbacks, but AI has proven to be transformative for many startups. It allows them to extract meaningful insights from data, enabling personalized experiences and predictive modeling. However, the upfront investment and requirement for extensive technical expertise can pose barriers. It justifies the risk for some, while others might wait for more accessible technologies or applications.
That brings us to another widely cited trend, the rise of the shared economy or collaborative consumption. It surely presents a nuanced approach with its focus on sharing resources.
Yes, the idea here is to make optimal use of available resources. Startups following this model can essentially reduce costs while still meeting consumer demand. We see this with companies like Uber, Airbnb, or co-working spaces, businesses providing shared use of a resource that might otherwise be underutilized. It's a very creative disruption of traditional industries.
Given these emerging trends, one could say they're double-edged swords, right? They open new opportunities, but at the same time come with their unique set of challenges.
Absolutely, Charlotte. For example, if we look at the shared economy, it can create vast opportunities by eliminating waste and making optimal use of existing resources. However, it can also raise questions regarding ownership, insurance, or regulatory requirements.
Yes, I see your point. These questions create a complex terrain, which startups need to navigate wisely. What about AI-driven startups? They must face their own set of challenges, right?
Definitely, it requires a significant upfront investment, and acquiring the right talent can be challenging. Plus, there are ethical considerations related to data privacy. With increasing regulations such as GDPR, it's essential for startups to develop robust data handling practices.
That's very true. We can't ignore the importance of creating trust with the user. Speaking of platforms, startups operating in this space also have their own set of challenges. They must amass a critical mass of both suppliers and consumers for the platform to be valuable.
Agreed. Achieving that balance isn't easy. Early on, the focus has to be on cultivating a committed user base. A startup that has done this effectively is Nextdoor, a hyper-local social network, encouraging neighbor interaction and community building.
That's a great example, Natalie. It really signifies the power of a solid network effect in platforms. Overall, while these emerging trends can be grounds for startups to distinguish themselves, they need to be prepared for stumbling blocks along the journey. So, circling back to our initial question, what makes a startup business model successful? Natalie, would you like to kick off?
Certainly, Charlotte. A successful startup business model captures customer value like no other. Whether that's through offering unique services, perfecting customer experience, or even building a strong community for your customer base, like Nextdoor accomplished with its platform model.
I'd also add that the adaptability of a business model can't be overlooked. No startup can anticipate every challenge that might come its way. So having a model that can pivot in the face of unforeseen hurdles, that's essential.
And let's not forget about revenue streams. The best business model would fall flat without robust and diverse sources of income. Relying on a single revenue stream can be horribly risky.
Absolutely. How about profitability and scalability? I mean, it's not just about making money from day one, but planning for future growth, preferably exponential.
Exactly, Charlotte. And this goes hand in hand with a thorough cost analysis. Keeping track of both fixed and variable costs and balancing them well is crucial in ensuring a startup stays afloat.
The list is endless. From ensuring sustainability across the triple bottom lines, profit, people, and planet, to distinct competitive advantage and a compelling value proposition. Starting a successful business requires a comprehensive understanding of every one of these variables.
That's exactly why we dedicated an entire podcast episode to dissect this topic, Charlotte. To help potential entrepreneurs and those interested in the investment landscape gain a solid understanding of these elements.